All right, so looks like the recession is finally starting because last week the GDP report numbers came in and economists were wrong. Remember, the GDP is the thing we use to measure how well the economy is doing, and economists thought that we wouldn't start slowing down until next year, but we've started to a lot earlier. Economists thought we would grow by at least 1.1% in the first quarter of this year, but instead we shrank 1.4%, which means we are halfway there to an official recession. Remember, that's when we have 2 quarters back to back of negative GDP growth. Now, as far as the stock market, the S&P 500 is concerned, we are down 13.3% year to date. And because we're down over 10%, we are officially in a bear market. But what's even crazier is that historically, based on the Dow Jones Market data, we just had the worst start to the first quarter of the year since 1939. Everyone's portfolios is a sea of red. Check this out. Technology, finance, communication services, healthcare, consumer cyclicals, industrial, consumer defensive, real estate, energy, utilities, basic materials. Everything is red. No matter what you're investing in, whether it's Bitcoin, Ethereum, or any other crypto, chances are you are probably losing money. And that's because we are officially experiencing the worst start to the market in the last 83 years. It's insane. As a millennial, I feel like I was promised one once-in-a-lifetime economic event, which I already feel like I've lived through, which was the 2008 financial crisis. But now it feels like there's some kind of mean joke going around that I'm not in on, because I feel like we're living through the 10th once-in-a-lifetime economic event again. You ever see those TikToks where people just clap and it shows off all the cool cars they own? Yeah, my portfolio is doing the exact opposite. So let's talk about what is going on in the markets. I'll help explain everything, and then I'll show you exactly how I'm planning to prepare. Let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay, because this week is extremely important. 8 times a year, the FOMC, the Federal Open Market Committee, or the central bankers, come together to talk about what future interest rates will be, like the masters of the universe they are. And on May 4th, Papa Powell is going to tell us what the next federal fund rate increase will be. And remember, the federal fund rate is the most influential interest rate that sets the cost of borrowing money pretty much around the world. So come May 4th, the market is predicting that we will increase rates by 0.5%. Now, anytime I watch finance videos and people tell me what the market is predicting or what it's thinking, my question is always the same. How do you know, and where is this stuff written? Now, here's how you can tell and follow this yourself. There's something called the Fed Watch tool by the CME Group, and it predicts what future interest rates will be based on what people are trading. And here's how it works. It uses data from something called the 30-day Fed Fund Futures Market. And you can think of this market as sort of like a place where investors gamble and speculate what they think interest rates will be in the short term, because these contracts are released every 30 days. And the way their prices work is like this. You take the number 100 and you subtract the expected federal fund rate from that. So for example, if in May we expect rates to be 1%, we would subtract 1 from 100 to get 99. So $99. And that's exactly what we're seeing if we actually check the Federal Fund Futures Market. And we can see for May, the contracts are priced at roughly $99.21. Now, what this tool does is it aggregates all of this data and information to try to predict what the market is thinking. So now let me show you how to interpret all of this data so you can use this yourself. I promise it's gonna make perfect sense. All right, I apologize ahead of time if this is already super basic to you and you understand. I just wanna make sure that everyone understands what I'm talking about. So if you click at the top the date, May 4th, 2022, which is the next time that the central bankers or the FOMC gets together to decide interest rates, which is gonna be this week, you will see 2 bar graphs pop up, one on the left and one on the right. And at the top of that page, you will also see the current target rate is between 25 and 50 basis points. Now here's what that means. That just means the percent, which converts to 0.25 to 0.5%, because 100 basis points equals 1%. The reason they're using these fancy basis points is because if we were to use percents, it would be confusing. For example, if right now interest rates are at 5% and I was to tell you, hey, interest rates went up by 1% today, you might think, okay, so now they're 6%? When I could have meant, no, 1% of 5% is 0.05%. Therefore, the interest rate is now 5.05, not 6. That's why it gets confusing, and that's why they're using these basis points, because it gives you an objective measuring stick. So remember, 100 basis points equals 1%. Right now, it is between 0.25 and 0.5%, or 25 to 50 basis points. Okay. Now let's get back to the bar graph. So the left bar graph represents the current target rate and the odds of it staying the same, which as you can see is anywhere between 50 to 75 basis points, which again converts to 0.5 to 0.75%. And right now, the market is pricing in that come May 4th, the odds that it will still stay the same to be 2.9%. So very slim chance that our interest rates will stay the same. Now, the right side, the right bar graph, represents where interest rates will most likely be. And as of right now, that is between 75 to 100 basis points. That's the market's guess. That's what it's pricing in. That converts to, once again, 0.75% to 1%. And the market is pricing in a 97.1% chance that rates will most likely be between that range come May 4th. So that's how this tool works. Now, there are rumors flying around that Papa Powell will announce at this Fed meeting that the next time the central bank raises interest rates, it could be as big as 75 basis points, or 0.75%, which is obviously one of the biggest increases that we've done in a very long time. So let's use this tool to look ahead into the future to try to see where interest rates might be later this year. If you click the 15th of June 2022, this time you will see 3 bar graphs. Now, the reason we're seeing more is because the farther out into the future you try to look, the more possibilities there become, because now we're making an assumption based on another assumption, right? And that's not always as accurate, so we have to account for more possibilities. But the same rules still apply, because the left side of the bar graph, so the first one you see, is what we expect the federal fund rate to be. That's our assumption. And that's anywhere between 100 to 125 basis points. So once again, anywhere between 1 to 1.25%. Now, the market is pricing in only 0.3% chance that the federal fund rate will stay the same come June 15th. Now, the middle bar graph shows there's an 11% chance that interest rates will be between 125 and 150 basis points, which of course translates to 1.25 and 1.5%. But what the market thinks is the highest probability of happening is when interest rates will be between 150 basis points and 175. It thinks there's an 88% chance, and that of course translates to 1.5 to 1.75%. Now, if we look way into the future, like November, for example, we will actually see 5 bar graphs. And that's again because the farther you try to see into the future, the more possibilities there are, and it multiplies. Until when we click on December, we will actually see 6 bar graphs. And that's exactly how Dr. Strange was able to look into the future and beat Thanos. He was using the Fed Watch tool. It's a true story. Now, I know it doesn't seem like it's important or that it's useful, but it's actually very important in helping us understand what's potentially about to happen in the future, and here's how you can actually use it. Whether you're looking to invest in the market, or you're trying to buy a house, or maybe you're thinking about retirement, you can kind of use this tool to see how interest rates might affect your decision. Now, I found research and data that compares what happens to the stock market when the central bank raises the rates by 50 basis points or more, and here's what I found. Since June of 1989, we have raised rates a grand total of 5 times by 50 basis points or more. The last time we did that was in May of 2000, so literally 22 years ago. So if this week we get a 50 basis point increase, it'll be a pretty historic event. And I predict another once-in-a-lifetime millennial economic event. Now, across all the different market indexes, from the S&P 500 to the NASDAQ to the Dow Jones and the Russell 2000, 2 weeks before interest rates go up, the markets on average have reacted negatively. And that's exactly what we're seeing right now. Think about it. 2 weeks before the interest rates go up, our market is reacting negatively. It's going down and down and down. So history is literally repeating itself right now. And 2 weeks after interest rates go up, on average, the markets have also gone down. And that's probably what's going to happen again. After May 4th, once rates go up, our stock market will probably still continue to tank. But after that 2-week period, the stock market starts to recover, and in some cases by a lot. And most of the recovery happens by the 6-month mark. Check this out. So as you can see, the Dow Jones is up 9.6%, the S&P 500 is up 7.5%, NASDAQ is up 9.7%, and the Russell 2000 is up 6.9% on average. So yes, the stock market actually reacts pretty negatively leading up to rate increases and immediately after rates go up, but in the long term, the market recovers big time, especially by about that 6-month mark. So historically, it might be a good time to consider investing anytime between May 4th and May 18th. However, there is a catch. The catch is that we're halfway through a recession, and when a recession happens, the S&P 500 on average falls by about 32%. And so far, our S&P 500 has only fallen 13.3%, which means we've only fallen 41.5% of the way there. So if we were to get a recession, the stock market has a lot farther to fall. But again, that's assuming we get a recession. Crypto hasn't been around long enough for me to give you any data, but so far it really closely tracks stocks. So whatever happens to the stock market will most likely be echoed by crypto, maybe not one-to-one perfectly, but probably close enough. Real estate's way too broad and too complicated to give you a blanket statement because it really depends on local conditions, on market demand, and a lot more than just interest rates. But one thing is true, in that the median home value is around $428,700, and it's becoming more and more unaffordable for the average person to buy a house. Now, bond prices will keep going down, but their yields will go up, especially once the Fed starts to sell off their bond portfolio. And this year, we could see a huge rotation out of stocks, which is where the other 50+% will come from falling in the stock market, and maybe a huge rotation into bonds as their rates go up. So I guess we'll see what happens, but all of this is from an investment perspective. And I think more important than investing is how a recession could affect our daily lives. So far, all the predictions and all the estimates I've given you are based under the assumption that the federal fund rate will be at 300 basis points by the end of this year, or 3%. Now, for inflation, that's hopefully a good thing because it means that the cost to live our lives will go down. But unfortunately, that's not a 100% given either, because there's a few things we just can't shake and can't make inflation go away. And the first is that when interest rates go up, it also means that companies have a harder time borrowing cheap money, and they could easily pass on those costs to their consumers, right? The second thing is the conflict in Ukraine. If that goes on longer than we thought, and if we get even more involved, that's also not going to help with inflation. The third is supply chain problems, like we're seeing in China once again. If that gets even worse, also not going to help inflation. And the last one is labor shortage. If we see these wage price spirals get out of control, and if companies have to pay people even more money to stay competitive, that's also not going to help inflation go away. There's a few things we just can't shake, and how long that's going to last is anyone's guess. Now let's talk about how to actually prepare for what's gonna happen. I made a separate video on how to invest $10,000 right now, which I should have titled How Not to Lose $10,000 Right Now, because that seems to be the name of the game. If you keep your cash, you're losing 8% thanks to inflation. If you're trying to invest it in the S&P 500, you're down 13%. If you're investing in crypto, you're probably down even more, and it doesn't even matter where you put your money, you're probably losing it. So how do you not lose it right now? And one of the possibilities is in bonds, specifically I bonds, which right now for May are yielding 9.6%, which is pretty crazy. And if you want to learn more about those, I made a whole separate video which you can watch somewhere around here. Personally, I'm still dollar cost averaging into the broad market. I'm still buying VTI, I'm still buying Bitcoin and Ethereum, but it's only because if there is a market downturn, I'm still young enough to where I can weather the storm and live to see the next cycle, but that advice might not apply to everyone. Please remember that recessions are not always the same as a bear market. Even though we're technically in a bear market right now, between 1869 and 2018, we've had 30 recessions. And of those 30, 16 of them have had a positive stock market with an average return of 9.8%, despite the fact that the GDP declined an average of 3%. So we've been in weird times before where the economy shrunk, but we still made money in the stock market. And the other 14 times where the stock market was negative, it lost an average of 14.2%. So again, the odds of you making or losing money in the stock market during a recession is about the equivalent of a coin flip, so personally, I wouldn't sit it out or do something emotional to change my strategy. The thing I would focus on, though, is to make myself indispensable to the company that I worked with so that if a recession were to happen, and if God forbid there were layoffs, I would be so valuable to the company that they just wouldn't let me go, and that's what I would personally focus on right now. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin with this BlockFi link right here. Go grab your free stocks, links are down below, and then go track them automatically with a spreadsheet, link down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday and Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.